Good morning. Liquidity versus location. Why fundamentals still matter in CRE. In commercial real estate, timing matters, but fundamentals win. While liquidity can temporarily inflate property values, long term success in CRE still depends on what investors have always known. Location, tenant demand, and cash flow are king. The liquidity mirage. So, when the Federal Reserve or major financial institutions inject liquidity into the market, investors often see an uptick in capital chasing deals. The result? Cap rate compression, higher valuations, and a sense that money is cheap again. But here's the reality: liquidity doesn't fix weak fundamentals, it just hides them for a little while. Think of liquidity like fuel. It can accelerate the market, but if the engine and your property's fundamentals aren't sound, you're not going to go too far. It's going to crud out. The illusion of cheap capital. Even in a world where credit flows more easily, borrowing costs remain elevated compared to the ultra low rate era of the 2010s, and many investors misread liquidity injections as a signal of cheap money returning. When in truth, what's returning is market stability, not the free money environment that fueled speculative buying. That's why the smartest investors still look beyond the short term trends and focus on properties that perform through cycles, with strong tenants, durable income streams, and growth markets. So here's a case study: hype versus fundamentals. One investor jumped on a multifamily acquisition in a tertiary market because everybody was buying the dip. And the deal penciled only because of aggressive rent projections. And 6 months later, occupancy dropped 20% and debt service coverage slipped below 1.0. So at that point in time, you're coming out of pocket. Another investor, however, stayed disciplined. They bought in Katy, Texas, a submarket with job growth, population inflows, and retail absorption. They paid a fair price, but secured strong tenants and stable cash flow. And 2 years later, they refinanced at better terms and grew equity through consistent performance. But here's the lesson: liquidity can inflate prices, but only fundamentals build wealth. And why location still reigns supreme? Well, markets like Katy, Fulshire, and Brookshire show how location drives sustainability, population growth, and infrastructure investment, as well as diversified employment bases, make these areas prime for long-term success. You can't outfinance a bad location, no matter how much cash the Fed pumps into the system. So the role of smart advisors. Well, at Viking Enterprise Team at EXP Commercial, we combine market insight with capital insight and strategy to guide clients through every cycle. Through Medallion Funds, we pair investors with tailored financing structures that balance liquidity and fundamentals, ensuring that deals are built on solid ground. Now, whether the Fed is tightening or easing, our philosophy remains the same: invest where fundamentals thrive. And that, my friends, is it for the day. Let's go, Aggies. Have a good week. We'll see you Monday.